Good morning, good afternoon, and good evening, wherever you are in the world. Welcome to the Convera Global FX Outlook webinar for April 2024. Very glad that you could join us today. We're just going to give it another minute or so. I'll let everyone join the call and then we'll kick off. Remember that you can use the Zoom controller there if you need to ask any questions over the course of the session, or you need to control how the webinar is looking for you. We'll be presenting a series of slides today, and always we'll be looking at some of the key big economic drivers that are impacting global financial and FX markets, and looking at some of the forecasts for our key markets that we look at down here in APAC, the Aussie US, the Kiwi US, dollar Sing, and dollar CNH. But like I said, we'll give it another couple of minutes to let people join, and then we'll kick off. Thank you. Okay, it's just gone 2 minutes past the hour, so let's all kick off. Glad that you could make it to the call today. My name's Stephen Dooley. I'm the head of market insights here at Convera, and joined today by Shirley Lim, who is our FX and macro strategist here in APAC. So I will kick off, and then I'll hand over to Shirley in about 10 minutes or so. But it's certainly been an interesting start to the year, a year that's really been dominated by US dollar strength. And we saw that in March last month. The US dollar actually saw quite a significant reversal from its lows that we saw at the start of the month. Quite a big move from those 2-month lows up to 6-week highs, and then in fact making it even further higher up to the highest level since November over the course of the month. Really particularly driven by the strong jobs numbers that we've seen from the US. We saw in March a very strong number, and then we saw another strong number at the start of April, which ended up being the 5th consecutive beat in the monthly non-farm employment series. So US jobs market remains solid. The higher interest rates in the US interest rates are currently the official rate from the Fed funds rate. The Federal Reserve sets is around 5.4%. The only developed economy with an interest rate above that is New Zealand at 5.5%. But with US the most dominant currency in financial markets, with its relatively high interest rates, it's meant that it's really been able to benefit from the high interest rates, but also from the strong growth prospects in the US. So the US dollar has just kept on keeping on so far in the in FX market so far this year, and that's really been the major standout that we've seen so far in 2024. The euro actually ended up a little bit lower in March, and again that was partly driven by that US dollar strength, causing the euro US dollar to reverse from quite a key technical level at 110. The strength of that technical level, which has been really key resistance for the euro US dollar all year, saw the euro weaken. And so we actually saw the euro weaker for most of the month in March, and that helped the Aussie euro move up towards 2-month highs. The euro actually also significantly lower versus the Singapore dollar. So that big reversal, that US dollar strength really helped the euro weaken. And what we've seen so far this year is that the euro has really been driven more by data that's been coming out of the US and the likely impact of that data on US interest rates. That's been the big driver of data, so of euro movements this year, much less so than the impact of European economic data. In the UK, the pound was moderately lower as well, again, driven by that stronger US dollar, which has really just been managing to push higher versus all currencies. Again, the pound appears to be in a trading range as well, much like the euro trading in a broader trading range. The pound US is also stuck in a range at the moment between around 125 and 129, waiting for a breakout in either direction, but for the moment, the pound mostly weaker throughout the month of March. And then the Aussie dollar also weaker, and quite a few really unusual drivers in the Aussie US at the moment, but the Aussie has been mainly lower, and again, like the euro, like the pound, finding very strong technical resistance above 66 cents. So between 66 and 66.50, the Aussie US has been reversing lower, providing a good opportunity for your Aussie dollar buyers, for your US dollar buyers in Australia every time we move up to that 66 level. So again, very clear technical resistance, but also the fact that the Australian dollar hasn't really been benefiting from strength in commodity markets. If you look at gold price, made new all-time highs overnight. Crude oil prices up at 6-month highs before reversing at the start of this week. Copper prices up at 1-year highs. So with commodities higher, normally the Aussie dollar tends to outperform. That hasn't been the case this year. And again, like we mentioned, the hot money in FX markets is going into the US, and it's causing that long-established linkage between Australia and commodity prices just to break down. And it's not going to be forever, but certainly in the short term, a number of factors working the US dollar's advantage means that even the Aussie dollar can't rally as gold prices make new all-time highs. So that's the outlook on the FX markets at the moment. That's the outlook for FX markets at the moment. But let's have a look at some of the big drivers in the global economic outlook for now. And first of all, we are starting to see more and more central banks cutting rates around the world. Most interestingly, last month we saw the first big developed central bank, the Swiss National Bank, cut interest rates. It was a surprise, but they said because the Swiss inflation outlook looked broadly contained, they were able to make that next step. So we've seen a lot of smaller central banks, particularly in Central Europe, particularly in South America, Israel. A number of central banks around the world have started to cut rates already, really since about November last year, but we're now starting to see the more developed central banks, Switzerland, for example, cutting rates. And the next big question is which central bank will go next? And of course, we've got the European Central Bank decision. That's going to be closely watched this week. And in terms of the US, the Federal Reserve at the moment, market pricing is currently caught between expectations for a rate cut in June or a rate cut in July. But we are clearly seeing the rate cutting regime has started. It's just a matter of waiting until we start to see more of these developed central banks starting to cut rates. Another factor that's been driving the US dollar higher, we mentioned first of all the fact that they've got the close to the highest interest rates in the developed world. They're a dominant most liquid currency. The dollar-yen pair has been the real focus of those carry trades, those speculative trades that try to take advantage of the interest rate advantage. But the other story, of course, has just been the non-stop gains in the US equity markets. And of course, you've heard non-stop about the Magnificent Seven, those technology stocks that are partly helped by a boom in AI, but the big push higher in US technology stocks has seen a series of higher highs, higher weekly all-time highs in the S&P 500, and that's been another big driver. That for the moment, the equity market rally has really been centered globally out of the US. And so that's been another factor that has driven the US dollar higher. And markets are what's driving this move is, first of all, expectations that central banks around the world will cut. And like we showed on the last slide, they already have started cutting. But also the possibility that most of the economic data that we've got has been better than expected. And that means that maybe the impact of higher interest rates won't be as bad on the global economy as perhaps economists and analysts thought 6 months ago. And so this is our last slide to keep an eye on, that economic data has been mainly surprising to the top side. And you can see where we've seen the biggest improvement over the first 3 months of this year has been in Europe. The Eurozone's seen a big pickup in positive macroeconomic surprises so far this year. You can also see in terms of the first three here that Japan remains at a higher level and the US also remains at a higher level. So the jump between January and March might not have been as extreme, but it remains at a very high level, along with perhaps surprisingly China. And China has seen a bit of a pickup in data. It's been reflected in a bit of an improvement in the Chinese equity market over the last 6 months, or sorry, last 2 months or so. So one of the big themes that we're being focused on is that even after the Swiss National Bank became the first developed central bank to cut interest rates, the volatility has still remained very low. But interestingly, as we start to see more central banks, more developed central banks moving in a different direction, and of course, last month, we also saw the Bank of Japan ending their period of interest rates, negative interest rates, to move into the positive for the first time since 2016. It shows that the divergence in central banks, the divergence in growth in particular, which is what we've been talking about, part of the reason why the US dollar has been strong, could start to pick up, see a pickup in volatility. But central bank divergence in and of itself might not be enough to really pick up significant policy moves in volatility. It might be the fact that an unexpected shock, a financial sell-off, geopolitical issues might be needed to really see a pickup to the volatility levels that we have seen during the more extreme period. So yes, we expect volatility to pick up as central banks start to move more, diverge more, but it might not be enough to see really significant levels of volatility. That might need something else. Okay, before I pass on to Shirley, let's have a look at what the outlook is for in terms of major events over the course of the year. First of all, the course of the month, I should say. First of all, these rate decisions that we're getting over the next few days or so, really kicking off tomorrow. or I should say on Wednesday, with the Reserve Bank of New Zealand on Wednesday, the 10th of April. Again, edging towards a rate cut, but maybe likely to be one of the central banks that cuts later than some of the others, with inflationary pressures still quite significant in the Reserve Bank or in New Zealand, and also particularly a very tight labour market. That said, the Reserve Bank of New Zealand has got a reputation for surprising, and B, a history of going ahead of most other central banks, being ahead of the curve. They were the first central bank to start raising rates in this cycle. So you can't discount anything with the Reserve Bank of New Zealand. That's out on the 10th of April. Also, the 10th of April, the Bank of Canada meeting. And on the 11th, watching carefully for the European Central Bank. That will be really quite key in terms of they're likely to be one of the central banks that might go earlier. So the decision they have on the 11th of April will be seen as really quite key. As we go through the month, 16th of April, a better read on the Chinese economy, Q1 GDP, retail sales, fixed asset investment. So that will be closely watched. And then as we move through the month into the towards the end of the month, those PMI numbers coming out on the 23rd, and Australian inflation out on the 24th. Okay, so like I mentioned, the European Central Bank is going to be one of the highlights this week, and in fact this month, as we look ahead to which of the central banks are likely to begin cutting first. The European Central Bank's interest rate decision, inflation has declined. Economic growth has also slowed down significantly in the Eurozone. So that probably gives the ECB a bit more room to move in terms of the inflation and the growth outlook. US inflation still not necessarily higher, but has been a bit more stuck at recent levels. Haven't seen it coming down as much. And also, of course, growth in the US has been really strong, driving the US dollar higher as well. So, most forecasters, including ourselves, expect Eurozone inflation to fall back below 2% by the middle of this year. So while this meeting might be too early for policy easing, it could give a signal that they're ready to cut in June. If so, this week, the biggest opportunity might be a move lower in the euro and an opportunity for euro buyers. So Thursday, Friday, that's going to be one of the key events of the month, that European Central Bank decision and the impact on the euro. All right, that's the economic outlook for April so far. I'm going to pass on to Shirley now, and Shirley will run you through the APAC currency outlook. Thanks, Shirley.
Thank you, Stephen. So moving on to the APAC value indicator slides. The Aussie dollar has definitely been losing some of its shine recently against both G10 and EM currencies. If we look at the data, the Aussie dollar is trading well below its 2-year averages almost across the board. For example, against the US dollar, the Aussie dollar is about 3.1% weaker than its 2-year mean, as the Greenback maintains its haven appeal amid all the global uncertainty. The story is similar versus the euro, with Aussie dollar sitting 4.8% below its 2-year average as tepid global demand wanes. Even when we look at Aussie dollar versus EM currencies like the Chinese yuan, it's only up 0.2% from the 2-year level, as those global headwinds readily seem to be dominating. The one bright spot is Aussie dollar yen, which has climbed over 5% above its 2-year average. But even there, we have to be a bit cautious as the Bank of Japan looks to exit its NIRP, which could end up capping some of those Aussie dollar yen gains going forward. Overall, it really paints a picture of Aussie struggling to find its footing against most major crosses as global growth concerns, especially around China, continue to be a significant drag. The RBA is certainly trying to walk that fine line, but the global backdrop is proving challenging for Aussie at the moment. Now we move on to the Aussie dollar currency slide. So what does the future hold for the Aussie? Well, in our central scenario, one key factor that could lend support is the RBA's resistance to joining this potential global cycle of rate cuts. Now, the RBA may hold steady at their upcoming meetings, but with US rates likely to remain above Aussie rates for the time being, that could cap topside gains in Aussie dollar, US dollar. For our downside scenario, we need to keep a close eye on China and any potential stresses in their financial system, particularly from those structural problems in the property sector. A bigger shock there could spell trouble for the Aussie, which remains susceptible to issues like global banking system dysfunction and tighter financial conditions. But there is an upside scenario that could leave the Aussie. If US inflation slows down faster than expected, lowering terminal rate pricing, we could see risk assets like the Aussie dollar benefiting. Additionally, if we see significant fiscal easing or stimulus from the Australian government, that could prompt the RBA to raise rates from here, boosting the Aussie dollar, US dollar. Now looking to the Kiwi dollar, in our central scenario, this currency remains vulnerable to any bouts of global risk aversion. Even if we do get some positive surprises from China on the growth front, the Australian dollar is just better positioned to benefit from an improving China outlook compared to the Kiwi. Our downside scenario for New Zealand US dollar sees the Reserve Bank of New Zealand being forced towards more aggressive easing. Despite the tight labor conditions currently, if the domestic economic recovery fails to gain traction, the RBNZ may have to double down on rate cuts, putting further downside pressure on the Kiwi. But we do have an upside scenario as well. A new government in New Zealand could adopt a more pro-growth agenda focused on tax cuts and deregulation to try and increase returns on local assets. That policy pivot could provide a lift for the Kiwi dollar. Firmer export prices, particularly for key commodities like dairy, could also provide upside for New Zealand dollar if driven by stronger Chinese household consumption. Let's turn our attention now to the Chinese yuan. In our central scenario, we expect economic recovery in China to slowly improve, aided by recent supportive policy actions from Beijing. A key factor here could be if the Fed does confirm rate cuts are coming, which could ease pressure on the US dollar and allow the yuan to appreciate. Our downside scenario has the PBOC delivering larger than expected stimulus to support growth. If this forces the Fed's hand towards more aggressive easing and rate cuts for the US economy, that could punish the US dollar and allow the yuan to strengthen more significantly. But we also have an upside scenario that sees yuan weakening further against the US dollar. Despite PBOC's recent policy easing efforts, if the slump in China's housing markets shows no sign of improvement, those lingering economic concerns could continue weighing on the yuan. And a wildcard here is if the Fed ends up delivering fewer rate cuts than markets are pricing, that policy divergence could prove additional upside for the US dollar. Finally, we turn to the US dollar Sing. Our central scenario has global growth remains fairly underwhelming, with Chinese growth staying sluggish. If that plays out, it could help US Sing pin near its recent highs as the US dollar's relative outperformance persists. Looking at our downside scenario, if the Fed's hand is forced towards cutting interest rates as the US economy really starts to lose steam, we could see US dollar coming under broad pressure, dragging US Sing lower in the process. Finally, the upside scenario is tied to a potential risk-off move in global markets. If we see a bigger sell-off in risk assets, that could trigger safe haven flows into the US dollar and leave US Sing further from these levels. And the Singapore dollar's nominal effective exchange rate drifts higher within its trading band, that could also pose some downside risk for the Sing against the US dollar. Overall, it's a complex picture across these major APAC currency pairs with a lot of cross currents in play. We'll be keeping a close eye on all these moving parts as we progress through the year.
Thank you, Shirley. That was great. Really appreciate your insight there on the APAC zone. All right, let's have a look about what's happening in the North American market as well. And you can certainly see that Shirley had mentioned earlier about the Japanese yen, the fact the Bank of Japan ended their negative interest rate regime, and that hasn't yet produced a significant change in the dollar yen, which has been pushing significantly higher thanks to that interest rate advantage with US interest rates, as we mentioned, up above 5%, and Japanese interest rates, at least until recently, in the negative. But it certainly does have the potential to turn. But for now, you can see the biggest variation between a market and its long-term average. Clearly here, the dollar yen up 25% above its 5-year average. But the US dollar mainly stronger versus most currencies. You can see the dollar CAD also at highs, nowhere near as significant as the dollar yen, but the dollar CAD up 3.3% above its long-term average. The Euro CAD around about its broad average here, in line with sort of the long-term average here. And to the downside, where we're seeing some of the biggest misses, the Aussie US, Shirley had already mentioned, down 6.5% versus its long-term average. The Kiwi US down 8% versus its long-term average, and the dollar versus peso, peso showing some real strength, 15% above its long-term average versus the US dollar. All right, let's move into some of the forecasts. And with the US dollar, as we say, recently strongly higher, the outlook for the moment does remain more positive for the US dollar. For the moment, you can see that the view for most of this year, with the pound to be broadly near current levels, around that 127 level for most of the year. What can drive a pound significantly higher? Well, an improvement in global growth. The British pound historically closely tied to expectations for global growth. And of course, if the Fed does look to cut rates quicker than expected, that can help the US dollar to weaken and the British pound to strengthen. To the downside, the UK, if it suffers more of a recession, of course, it fell into a technical recession at the end of last year. Early data has been more positive. If it slips back into a recession, that can push the pair cable back down towards the lows. But overall, we mentioned right at the start that it's been in a trading range between 125 and 129. Certainly in the meantime, in the short term, that looks likely to persist. In the euro versus the US dollar, again, talking about that trading range that we've been in between 107 and 111, that certainly looks like the case in the short term as well, providing an opportunity for your US dollar buyers to move up to around 110, 111, an opportunity for your euro buyers down around 107. But again, the Federal Reserve move will be key. If they look to cut rates quicker than expected, that can push the euro US dollar higher. If the Eurozone ends up going early, that can push it back below that 107, and certainly the possibility that we can go down to 104 or 102. We mentioned earlier that a lot of the movement in the euro US dollar recently has been driven by Fed expectations. In the short term, that might change. Thursday night's ECB decision, absolutely key, but over the medium term beyond that, the Fed might remain the key driver. And where we do expect to see a little bit of US dollar weakness, and this was something we saw in the Kiwi, something that we saw in the Aussie as well, that some of those commodity currencies might eventually be able to build some strength with the big rally we've seen in commodity prices. Of course, when it comes to commodities, the Canadian dollar closely tied to the oil price. We already mentioned the oil price moved up to $6 month highs over the weekend. So that's why we are looking for more strength in the Canadian dollar, and that can push the dollar CAD back down to, you know, sort of at 132, 130 level towards the end of the year. Again, there is the possibility that we can break further lower from that level if the Fed is forced to cut rates quicker than expected. That can push the dollar CAD further lower as well. But again, we do expect to see, as we mentioned, a pickup in volatility in the first part of the year by this divergence in central bank moves. That's what can drive some of the volatility in the dollar CAD. Towards the end of the year, of course, geopolitics and the US presidential election likely to be key. In terms of what you know, our business can do for our customers is, you know, thinking about what we're able to do if we continue to see the current moves we've seen in FX markets of around 5 to 10%, or even bigger moves. You know, the Aussie US long-term average trading range about 19% per year since 1983. So, you know, we've recently been through a period of lower volatility. Higher volatility can come back at any time, and our risk management tools can help you manage that currency risk. We mentioned some of the geopolitical moves we've seen over the last 12 months, 2 years, not just what they do for FX market moves, but in terms of how it impacts on supply chains. That's really key as well, and you know, we can help businesses with the diversification. And geopolitics also can have an impact as well on sanctions, and international payments are complex, and we've got the ability to help your business as well by managing some of the complexities around international regulatory issues like sanctions. So thanks very much for coming along to today's webinar. If you've got any questions, you know, feel free to contact us on the details there below. Don't forget, we've got a survey here as well. So if you want to get out your phones and click on this QR code, you know, we'd be grateful to get your feedback. It helps us understand what our customers and stakeholders are interested in and what more we can do in these monthly presentations. We've got plenty of other information that you can download the report either through the controller here in the resources section. We'll put that up for you now. Otherwise, you can go to our website at convera.com and download the report. We've got a whole range of other forecasts that we can help you with. All the pound forecasts you can see here, euro forecast right across Asia and in the US market as well. So they're all available on the global FX outlook that we put out each month. And as I say, if you've got any other questions, you can contact us directly. Thanks again for attending. Thanks to Shirley for presenting also today. Really grateful for everyone coming along. We'll wrap it up and look forward to speaking to you all again soon. Thanks, everyone. Bye-bye.